I think that's the largest part, the largest share of the improvements that we will see from artificial intelligence at present will come from the monthly commentaries that we have to write for our clients.
Hi and welcome to Munich. With me is Filippo Stefanini, Head of Fonds-Selektion from Eurizon Capital. Hi Filippo, lovely to have you here.
Thank you for having me.
So investors are increasingly allocating more and more ETFs in their portfolios and makes it more difficult for active fund managers to find a place in the fund selectors' portfolios. Do you still see value in active funds and active managers? And when you do use ETFs, when do you use them?
So we still see value in fund selection. If we look at the performances of average peer group excess returns of active funds, we see that there is a lot of alpha generation, especially in the fixed income side. Often in the newspapers, we read articles about US equities where we see that active funds struggle to generate performances. So usually we use ETFs where we think ex ante it's more difficult to generate excess returns, like for instance in US equities where we tend to prefer low tracking error type of exposures, and so we tend to prefer some exposure to ETFs, while in other asset classes we prefer active funds where we see that there is on average in the peer groups a good alpha generation over time. Then we use ETFs to implement tactical asset allocation decisions because the dealing and it's faster and easier. While we use funds not to make trading decisions, but to implement strategic asset allocation decisions over time.
We also see, and we discussed this in the discussion, we see a trend towards boutiques, especially in Germany. And something interesting you mentioned was you manage 40 billion and it needs to be valuable to have a boutique in the portfolio. Do you select boutiques in your fund selection process? And when do they find a place?
I answer you giving a couple of numbers. We have a buy list, so a list of approved funds of around 230 names, but the fund houses of these 230 names are 65. So on average, this means that we pick few funds for each fund house. That at the end is more efficient to us because our process is very disciplined and requires a deep due diligence both on the fund and on the fund house that must be periodically updated at least once every year. So for us, it's more efficient to buy few investment solutions from a certain fund house than to have 230 different fund houses. No, so it's a question of efficiency in our job. So we work both with large fund houses and with small investment boutiques. And we tend to pick the funds of investment boutiques more in niche areas of the market or for niche investment strategies, where the large fund houses are less interested, maybe because there are capacity constraints. No, so the market opportunity maybe is smaller, the size of the market is smaller, and so it's not so strategic for the large fund houses to be present in those kind of environments.
Obviously, we know, especially with boutiques, how important the fund manager is for a fund. How long do you stick with a fund manager, especially when he starts to underperform or when his fund is not working in a certain environment?
So the last thing we want to do is to sell a fund that we have spent so much time to analyze, to approve. So we want to stick with the manager as long as possible. Of course, we monitor the relative performance of a fund manager compared to the peer group. So we cannot accept a certain manager, a certain fund to underperform above certain thresholds that are set up in our investment process. And we have a monthly check by our risk management department that check independently from us the risk-adjusted performances of a fund compared to the peer group. when a certain fund underperforms the peer group, we start to engage with the portfolio manager to understand what's going on, the reasons behind these underperformance. Just maybe make you an example to understand if there is a stop loss that has been triggered so that the underperformance has been consolidated, or if the managers stick with the positions to wait for a rebound. And so we have to understand that very carefully.
So one other topic we cannot not speak about at the moment is artificial intelligence. And I wouldn't like to talk about if you have it in the portfolio or not, but what would interest me is, do you use artificial intelligence for fund selection at all?
I think that the challenge for that is to understand really well the use cases. So the part of the process of the fund selection that can be enhanced by the artificial intelligence. And there are many, for instance, translations, summaries. But I think that's the largest part, the largest share of the improvements that we will see from artificial intelligence at present will come from the monthly commentaries that we have to write for our clients. We have a project that we are testing now to produce a draft of all the commentaries that we have to write at month end, quarter end, semester end, and year end. There are so many that are required by our products. No, that would be a huge saving of time that we will invest, dedicating more time to look at fund managers, to look at our due diligence, and to look at the financial markets.
Make you more efficient, give you more time to fund select. Thank you for taking the time today to be in here. Thank you very much for your insights.
Thank you for having me. It's a pleasure.